name is Lizzy Morrissey and I'm with NFP Insurance Solutions. I'm joined today by Jacob Hartz, Managing Director at the firm, and we're here today to talk about estate planning and estate taxes. So Jacob, thank you for joining me.
It's my pleasure.
Yeah, very excited for our conversation today.
Me too.
So with estate planning and estate taxes, I've been getting a lot of questions about this. There's a lot that's kind of been coming up in the news about it. So I'm curious to hear a little bit more from you and to hear your perspective on the intersection between estate planning and life insurance.
Sure, absolutely. So I think that there are three main ways that life insurance and estate planning work together. The first is the most basic, and that's like most people think of life insurance as a risk mitigator. It's what happens when the main breadwinner dies or one of the parents dies. How are their kids, the spouse, anyone who's dependent on those people, how are they going to provide for their lifestyle, for here until, in perpetuity? And in many ways that is a form of estate planning, because I think of estate planning as kind of like post-mortem financial planning, right? So what happens to your affairs, what happens to your money after you die? The second way that they intertwine is when you think of how much do I want to leave to each of my kids or each of my heirs, and you're thinking more about your legacy. What do you want to leave behind? And so as people are saving up in order to leave a legacy, there's a lot of risk in terms of volatility in the markets, whatever they're invested in, whatever their savings are. There's risk in terms of their spending requirements and how long they're going to live. Are they going to outlive their money, or are they going to outlive those goals for their legacy? And so life insurance is a great way to guarantee that X amount of dollars goes to each heir no matter what else happens. You can live your retirement carefree, basically, of like leaving enough money for each of those kids, spend it all, have a great time. No matter what happens, you're going to have that legacy for each of those kids. And then the third way is where people might have estate tax, and we use life insurance to help offset or actually pay that estate tax.
Interesting. Okay. And to that point of estate tax, there's something that I've been reading about, hearing about, that estate tax exemption limit is changing, that it might be decreasing next year. Could you talk a little bit more about that?
Absolutely. And the first question is really, what is the estate tax exemption? So the estate tax exemption is the amount of net worth that you can have before the government starts taxing your estate upon death. So currently, that exemption limit is about $13.6 million going into 2024 per individual. So that's about $27 million per couple that they can have as their net worth before they get an estate tax. Everything over and above that $27 million is taxed at the 40% federal estate tax level. There are state estate taxes that might apply depending on what state you live in that could kick in at a lower level, but right now for this purpose we're really just talking about the federal estate tax. And what's set to happen, unless Congress acts to extend the current level of the estate tax exemption limit, is that the amount of that exemption is going to come down significantly in about a year. And so what clients are kind of thinking about now is, well, first of all, what's it going to come down to? Because we're not exactly sure. It is indexed for inflation from the previous exemption limit, so it could be somewhere in the neighborhood of $7 or $8 million per individual, but we'll know when we know. Really, our job is to make sure that our clients have the cash on hand to pay the estate tax bill when it comes due, whatever that happens to be.
Interesting. Okay. And speaking of cash on hand, that's something that we get a lot of questions about too, is if your estate is more liquid or less liquid. Can you talk a little bit more about how that would play into life insurance and estate planning?
Yeah, absolutely. So this is a question that we get all the time, obviously, and the amount of planning that you do around having the cash ready to pay the estate tax depends on what your estate is composed of. Is it composed of a bunch of cash and bonds and publicly traded securities that are easy to sell, buy and sell at a moment's notice when that tax comes due? Or is it composed of things like a family business or a real estate portfolio, or certain luxury items like art or yachts or trophy real estate, things like that might be harder to sell at the price that your heirs want or need to sell them at in order to pay that estate tax and not, wipe out their inheritance or significantly diminish it. So what happens in that situation? There's kind of two ways that we can use life insurance for those different types of estates, one being liquid and one being illiquid. For the state that's liquid, there might be a measure of volatility in the things that the estate is invested in. So life insurance, again, same as planning for just leaving a legacy after retirement, life insurance can help add a measure of predictability to the estate upon death by having some certainty that X amount of dollars is going to be available in cash immediately upon death, and you don't have to worry whether the portfolio is up or down or what happened in the meantime. You have that level of certainty to offset volatility. On the other side, for illiquid estates, it's a major problem because sometimes we have clients who have a net worth of 50 million, 100 million, $1 billion. A lot of that might be in their family business or whatever it is. Oftentimes it is a family business, and they have very little liquidity. So you could have, let's just say for round numbers, $100 million of net worth, and $80 million of that is the family business. So they have $20 million of net worth. But when you think about calculating the federal estate tax on that $100 million estate, so again, the first 27 million is exempt, and so that leaves $73 million left over, 40% of 73. I'm going to butcher the math, but call it approximately $28-30 million. Okay, so where are they going to come up with $30 million to pay the federal estate tax, let alone any state estate tax if they have that? Well, they don't have that much cash on hand. They don't have that much liquidity. So they either need to sell a piece of the company, which probably doesn't sound too appealing, or they need to take on debt in order to meet the estate tax.
Which at that point, if there wasn't passing, that would be extremely stressful to have to deal with.
Exactly, and eventually they have to pay that back anyway. They might qualify for a deferral. They could defer their estate tax until a later date, until they have that liquidity. But again, they're going to eventually have to come up with that $30 million of cash to pay the government, whether it's today or in the future. So life insurance is a way to provide cash to pay the estate tax when there's no cash available. It creates liquidity for an illiquid estate.
That's awesome. I love that.
It sure is.
Yeah, so one thing that comes to mind too is if you have a life insurance policy, is that not considered part of the estate then that's going to be taxed?
Yeah, so that's a fantastic question because this is a mistake that we see made all the time, especially for people who start out below the estate tax exemption limit and then their net worth grows significantly and they forget to remove their life insurance from their taxable estate. Because the short answer to your question is yes. If you have a life insurance policy and it's just owned by you, it's in your estate, that is part of the estate, the death benefit. So what people do in order to remove that from their estate is they put it in an irrevocable trust, sometimes called an ILIT, an irrevocable life insurance trust, but it really could be any irrevocable trust that's for legal purposes considered outside your estate. So what happens is the trust owns the life insurance policy. The person who sets up the trust, the grantor, makes gifts to the trust in order to fund the premiums, or if the trust owns other assets and has other means of paying the premiums, the trust itself can pay those premiums. But when the insured dies, the life insurance policy pays out into the trust. So now the trust has all that cash from the life insurance policy, and it uses that cash to buy assets from the estate at death. So now those assets are in the trust, and the estate has the cash that it made from the sale of those assets that it can use to pay the estate tax. And so long as Congress doesn't get rid of the step up in basis, the sale of those assets from the estate to the trust should be tax-free because there's no capital gains on that sale, because the heirs get a step up in their basis up to that fair market value at the time of death. So it's a very clean and efficient and elegant way to provide liquidity at the time of death.
So do you have any clients that you can think of that have done something similar to this, that have done that type of life insurance to help with estate planning?
Yeah, absolutely. I would say actually this is kind of our bread and butter client in many ways, is the client who has a large illiquid estate and they're looking to find that liquidity. Happens all the time, but if I were to pick out one example, I would think of a real estate owner, real estate investor who was in his kind of mid-50s. Net worth was about $50 million, and so all the factors that I mentioned before kind of played out very nicely, where he was able to obtain about $20 million of coverage in order to offset his future estate tax bill, and it worked out very nicely for him.
Yeah, that's great. And hearing those examples just really illustrates the point of what we're talking about today.
Yeah, absolutely.
So last question I have for you
Sure.
is, if a client or someone were interested in taking that step, learning more about life insurance for estate tax planning, what should be their first step they would take?
So usually we get introduced to our clients through their advisors, but we often meet clients, in the wild, so to speak. And when that happens, it's our responsibility to kind of help them line up their different advisors. But really, the first step is to involve an estate planning attorney, so that we can all get on the same page in terms of what we're trying to accomplish, how much estate tax we're trying to offset, and we might want to talk to a financial planner, financial advisor to help project how much estate tax is anticipated. But really, I think the bottom line is we want to talk to all the people who are giving our clients advice, because our role is to play this part of insurance advisor and insurance expert on our client's advisor team. And when everyone on the advisor team is on the same page, and everyone on the advisor team is aligned in how we're serving the client and what goals we're helping the client achieve, then that's where we have the most success.
Yeah, that's awesome. Well, Jacob, those were all of my questions for today. Thank you so much for joining me. I personally learned a lot, so really appreciate your time today.
My pleasure. Let's do it again.
Definitely.